making returns in the markets are actually statistically more likely than you might have thought. You see, normally people look at just the 1 year. But what happens if you look at frequency of rolling 2-year, and we'll focus on the S&P 500 returns since 1950? Well, it was positive 88.5% of the time. The average positive return was 32%. 32% is the average positive return over 2-year S&P 500 since 1950. So what's the problem? And this is the problem. This is the bit people don't quite get. Whilst the worst return was minus 45%, the average negative return only minus 18%. You said, well, I can take minus 18 if I'm getting positive 32, and I'm getting positive returns anyway 88.5% of the time, and negative returns only 11.5%. The problem is this. If you could reduce this even by half, let's say you missed half of the downturns and half of the down years, in other words, not all of them, you didn't manage to pick the tops and bottoms, without impacting or barely impacting your positive years, if, and it's a big if, then you would do significantly better. And one of the best ways I found in order to do that, well, there's two. One is complicated, one is less complicated. Well, one is simple, one is a little bit more complicated, but both are objective. The first one is if the market falls X percent, you exit. Now, for me, that X percent has usually been 15 to 20%. Okay, you just exit. And you might say, well, that's a lot you're giving up. I mean, from the high, from when you bought it that year, you'd still need a re-entry. So it's a little bit tricky, but it's mathematics, not opinion. Okay, that makes it simpler. The other one, which is slightly more complicated, is I look at the monthly momentum indicators. And if you want to know what I'm talking about there, and again, they can be objective because I'm just looking for what's called a crossover. And why do I look for objective measures as opposed to reading the news and the narrative? Well, very simple. When you watch the news today, I want you to think about every single news item and think about the person who will have the exact opposite opinion on that to you. Narratives are open to opinion, conjecture, all sorts of biases. And you might say, well, that doesn't matter. I'm right. I'm correct. Well, the market doesn't really care what you think, I'm afraid. You're not a causal element for market movements. Surprise, surprise. That's why I prefer specific piece of data like has it dropped X% from the peak, because you can't argue with that. Maths is maths, although there are some people there who, if you say what's 1 + 1, they will argue with you over what the answer is. Trust me. Have a look at alpeshpatel.com/links and go to my private Telegram channel to learn a heck of a lot more.